Oh, look at that day out there. It is another beautiful day here in South Florida. I'm Kenny Polcari, your host of the party. And today is Thursday, March 3rd, 2022. And what is it that we need to know about the markets? What happened yesterday is the markets took off and Jay Powell takes to Capitol Hill. So let's talk about that and let's talk about what to expect today. So rates are on the rise, right? And Algo's absolutely loved it, taking stocks higher. All while Vlad pushes deeper into Ukraine, but remains just out of control. Global sanctions are really beginning to start to sting him. OPEC holds production steady despite the surge in oil prices. And Jay, who appeared on Capitol Hill yesterday, is said to reappear today. Expect more of the same. And what are we having for dinner tonight? We're going to try the Herb Balsamic Marinated Pork Chips. Delicious and easy to make. Okay, wait, what happened yesterday? Stocks did what? Jay Powell said what? All while Vlad pushes deeper into Ukraine and oil and other commodities continue to push higher and higher. Oil yesterday piercing $112 a barrel before settling in at 110. And this morning, it's trading up another 2.8% or $3.20 a barrel at $114 a barrel as OPEC and its allies have decided to hold production steady despite the spike in oil prices over the past 3 months, over the past 6 months, over the past year. Anyway, it was all about the Fed. It was all about what Jay Powell was going to say. Investors putting Vlad and Ukraine on the back burner as they listened intently to what Jay Powell had to say to the House Financial Services Committee during his biannual Humphrey Hawkins testimony. And they liked what they heard, or at least the Algos did. Jay told the committee and the world that he would propose a 25 basis point rate hike at the next FOMC meeting, which begins on Tuesday, March 15th and ends on Wednesday, March 16th. It was not the classic Jay. He ended the debate versus leaving it vague the way he usually does about what the next move will be. Recall that the speculation had been for 50 basis points of an increase, right? I was in that camp, but he put that argument to bed, saying this: for now, I would say that we will proceed carefully along the lines of the plan. We're going to avoid adding additional uncertainty to what is an already extraordinarily challenging and uncertain moment. Carefully here defined as 25 basis points. And so I say, do you think it's about time? He was hit on both sides by members of the committee when it came to understanding inflation. Many now putting the blame squarely on him and the Fed, saying that he held rates too low for too long, which so many of us had known and been screaming about since the spring of 2021, when many analysts and strategists were encouraging the Fed to move. Yet they remained stubbornly attached to zero, saying that they didn't see the problem that the rest of us did. Now look, a 50 basis point increase was put to bed yesterday, but not for the future. He left the door wide open to the possibility that this summer we could see the more traditional 25 basis point increase that many expect not being carved in stone, and that he and his colleagues expect to see inflation continue to rise before it begins to fall, which is a brilliant assessment. I mean, look, and what I think was really a laughable moment and comment during this Fed hearing yesterday, he went on to say, when asked, that this is strong, high inflation, and it's very important that we get on top of it. And that's exactly what we're going to do. To which you almost have to laugh, because if he thinks he's on top of it, get on top of it? Really? Did he say that? I mean, listen, I hate to tell you, Jay and the rest of the committee, that boat sailed months ago. You guys missed it. You can't possibly believe that anyone thinks you guys got this and that you guys are on top of the inflation issue, can you? I mean, think about it for 1 minute. Come on. Inflation at the producer price level is about to print with a 10 handle. A 10 handle. And you think you got this? You're telling us you're ahead of this curve? I don't think so. No matter. By the end of the day, though, investors and algos love the clarity, right? They love the fact that they now know what to expect in 2 weeks. Remember, the market hates uncertainty, but it embraces certainty, no matter what that certainty is, good or bad, as long as it knows it. So while many had priced in that 50 basis point increase, they were surprised that he defined it so succinctly and promised only a 25 basis point increase, which leaves the Fed still in a dovish position, allowing the algos to go hard wild. The Dow gaining 600 points or 1.8%, the S&P up 80, 1.9%, the Nasdaq up 220, 1.6%, the Russell up 50 or 2.5%, while the transports gained 400 points or 2.6%. Advances were broad across the board, with most sectors up better than 2%. Financials taking the lead up by 2.6. They've gotten beaten up recently. Energy up 2.3. Basic materials, industrials, technology, and consumer discretionary all up better than 2.1%. Real estate up 1.8. Utilities and consumer staples up about 1.2, leaving communications, XLC, up just under 1%, right at 0.9%. As you can imagine, though, the short hedges, right, the short hedge trades that we've been talking about fell as the markets advanced. The DOG was down 1.7, the PSQ was down 1.7, the SH was down 1.8. And if you were playing the short side with the triple levered ETFs, be careful, the SPXS, which got whacked when as the markets rose, that fell by 5.3%, while the triple levered long SPXL surged by the same amount, 5.3%. Value continues to outperform growth, with SPYV up 1.8, SPYG up 1.7, leaving those indexes down 2.7% and 12% year to date, respectively. 10-year Treasury yields also surged as money moved out of the safety trade and into the risk trade. By the end of the day, the yield moved from 1.71% to 1.86 and only going higher. 30-year rates moved higher too. Conventional loans are now 3.7%, while jumbo rates are topping 4%, and they are expected to continue to move higher, and that's going to put a cap on housing, finally, leaving so many who are priced out of the market, unless, of course, housing prices decline, offsetting the rise in rates, which is exactly what should happen if Econ 101 is correct, right? You can expect that lag, though, to be about 6 months before we see any movement in housing prices if rates continue to go higher. And today, it's round 2 on Capitol Hill, but I would not expect the same dramatic move as many analysts and commentators begin to dissect and digest his comments and what that means for future increases. Bill Gross, the former bond king at PIMCO, is not a believer that yesterday's move in stock prices was justified at all. He thinks we're in for tougher times ahead and makes note of the fiscal drag that is yet to come. This could be on a number of levels, right? Now, if you look up fiscal drag, what you're going to see, it's really defined as the economic condition whereby inflation and wage growth moves taxpayers into higher tax brackets, increasing government tax revenues without really increasing government rates, right? The increase in taxes reduces aggregate demand and consumer spending from taxpayers as a larger share of their income goes to taxes, which leads to deflationary policies or a drag on the economy. You can also say that the Fed's going to start to withdraw stimulus. That's also going to be a drag on the economy. In any event, it was what it was. And today is a new day. The Russian-Ukrainian crisis now enters week 2. Vlad is frustrated with his lack of control over the region. He thought it would happen in 2 or 3 days, right? That they were just going to lay down and roll over. But it's been completely surprised by the strength and commitment of the Ukrainians and by the response of the civilized world to his unprovoked attack on this sovereign nation. I think what you have to worry about is, look, the other thing is noted is that Jay's going to appear on Capitol Hill starting at 10 o'clock this morning. He's going to resurrect the conversation from yesterday. Do not, though, expect the message to be any different, right? Just attacked from different angles as the Senate now gets their shot at him, right? The conversation will be the same. It'll be about inflation. It'll be about rates, what he thinks, right? So what are they going to learn and what are we going to learn today if we learn anything new at all, which I don't suspect we are. In the end, though, soaring oil prices and soaring commodity prices threaten to unleash more volatility in the days ahead, and stocks are still in a downward trend that really began on January 4th when the S&P ticked at an all-time high of 48.18, only to fall by nearly 15% by February 24th, which ended the day at 41.14. Yesterday's move leaves the S&P at 43.86, still down 8% year to date and below all 3 trend lines. 44.63 is the level to watch. It represents resistance. It's the 200-day moving average, and with the 50-day moving average turning lower, We're just days away from what could be a death cross. That's when the downtrending 50 pierces the rising 200, indicating the potential for another sell-off. So keep your eyes focused on the technicals over the next week or so. The death cross, if it happens, could see the S&P retest the February 24th low of 41.14 before this is over. U.S. futures this morning were green, but now they've turned slightly red. The Dow down 78, the S&P's down 12, the NASDAQ off 60, and the Russell down by 11 points. Eco data today includes the usual suspects, initial jobless claims and continuing claims, but it also includes unit labor costs, expectation of up 0.3%. Market services PMI of 56.7, which is bullish. ISM services PMI of 61.1, even more bullish. We're also getting factory orders up 0.7%, durable goods of plus 1.6, and durable goods ex transports of up 0.7%. Those are all the expectations. Tomorrow brings us the all-important non-farm payroll report, and the expectation is for an increase of 418,000 new jobs. Or I say restored jobs, because we're still 3 million jobs away from where we were prior to the government-mandated COVID-19 shutdown 2 years ago. So before you can create new, you have to regain the lost ones first. Yes, it's all semantics, but it is what it is. New is new, not old. Unemployment is expected to come in at 3.9%. Average hourly earnings are expected to be up 5.8% year over year and up 0.5% month over month. Labor force participation holds steady at 62.2, while underemployment hovers just at 7%. I think last month it was 7.1. As you can see, the geopolitical issues can cause short-term chaos, and they have, and I've said this many times, and that's what Vlad has done. But investors then begin to push that back to the back burner once it becomes clear about what the outcomes could be, and they start to refocus on the economic fundamentals in this country. The walls are beginning to cave in all around Vlad. More companies are cutting ties with Moscow. Banks are pulling back from financing, and the threats of new sanctions are keeping buyers at bay. Loyal oligarchs are now getting hammered. Threats to their wealth are real, and so we're beginning to see cracks in the wall. Tankers filled with millions of dollars of Russian oil are headed to the U.S. The question is, what will we do? Accept delivery or turn them away? Sanctions are expected to continue to push oil prices higher, along with other supply chain issues. China is now left in a tough spot. Should they jump in and help mediate the crisis, or will Xi sit back and watch it all implode? It's a really tangled web we weave. This is absolutely not the time for investors to fall asleep. European stocks this morning are also lower. Not dramatically, but they're all lower by about 0.7 to 1.5%. Reports of explosion in Kiev overnight, putting the invasion into a new position. Kharkiv suffered heavy bombardment yesterday, while Kherson is now supposedly under Russian control, right? And that's the port on the Black Sea. Yes, there are individual company earnings due out today across Europe, but the reality for Europe remains what is happening in Ukraine. The continued uncertainty are going to continue to affect Europe much more so than they're going to affect the U.S. Cryptos are holding steady. Bitcoin is trading at 43,500 and Ethereum's trading at 2,900, just below the 3,000 mark, where it's been hovering, over the last couple of days. The S&P closed at 4386. I defined already what to watch for. We remain in the 41.14, 44.60 trading range, the range I identified a couple of days ago. I do expect we need to retest the low before this is over. And recall, a failure there on that low could see the S&P trade to 38.50 before finding more support. Yesterday's clarity from the Fed has certainly helped. What the market really wants to see now is clarity on any diplomatic conversations guided by China or anyone else, and if those conversations are positive, then expect markets to move higher, both swiftly and aggressively. If not, then the move lower becomes more of a reality. Vlad needs a way out to save some face, but he's sealed his fate in history. Everyone is going to have to compromise if this crisis is going to come to an end. Remember, now is the time to stick to the plan. Call your financial advisor to discuss, or call me to discuss. I'm always happy to have the conversation. Okay, so what are we having for dinner tonight? As I look out over the ocean here, and it's an absolutely spectacular day, I decided we're going to make the Herb Balsamic Marinated Pork Chops. They are simple to make. You let them marinate overnight. You put them in the oven the next day on bacon, then broil, and it's simple. So you guys start with 4 to 6 pork chops on the bone. You can have them thin cut or thick cut, whichever you prefer. This one I usually use the thinner cut ones. You're gonna rinse them, pat them dry, you're gonna set them aside. In a bowl, you're gonna add olive oil and balsamic vinegar at a 1-to-1 ratio. Then you're gonna add some dried rosemary and thyme and fresh basil to that oil balsamic mixture and mix it all up and kind of let it blend. Now you're gonna season the chops with salt and pepper. You're gonna marinate the chops in this oil balsamic mixture for at least 1 hour, but you can prepare this the night before and just leave it marinating in the fridge overnight, just so you know. The longer it marinates, the better it's gonna be. So if you need it, make it that night, you can marinate it, let it sit for an hour. If you wanna make it for tomorrow night, marinate it tonight, let it sit overnight. When you're ready to cook them, you're gonna preheat the oven to 400 degrees. You're gonna place the chops in a baking dish with the marinade all over it, cover it tightly and place it in the oven and cook it for 30 minutes or so. Once you do that, take the cover off and turn from bake to broil and put the chops underneath the broiler to create a bit of the crust, right? Once it's on crusty on one side, you want to flip them and repeat on the other side. Be careful, don't cook them too much because you'll dry them out. Don't put them right up against the heat, put them in kind of in the middle rack. And you can also do these on the grill if you want. If it's a nice night out and you want to heat up the grill. You want to serve this dish with roasted smashed potatoes and a green vegetable, something like a French cut green bean, maybe steamed and dressed with a dab of butter and some salt and pepper. Make it simple. As usual, you can serve it with a big salad, Boston bib lettuce, arugula, red onions, cucumbers, and tomatoes. And you can top this off with a nice Pinot Noir because it always works well with this meal in any event. It is now 7:30. You can see the sky is beautiful behind me. The sun is out. It's a warm day here in South Florida. It's going to be another great day, I think, in the markets. Maybe some churn, but I think, at the moment, we're still, the path of least resistance is higher today while Jay is still testifying in front of the Senate. In any event, until tomorrow, take good care.